With us live this morning from Stamford, Connecticut is Don Brownstein, CEO of Structured Portfolio Management, a hedge fund that specializes in mortgage-backed securities. Don, good morning and great to see you again. We've been telling everybody that as part of its earnings release, J.P. Morgan said it's setting aside $1.3 billion for litigation reserves, and those reserves include some money to settle mortgage-related issues. I can't imagine that surprises you. What does it tell you about what we're likely to hear and where this situation is likely to go in the courts?
Well, you know, the industry has been basically saying that there were three possible courses that this thing might take. One would be a pretty moderate one in which basically some paperwork had to be cleared up and some decisions made in the parts of some courts. The other was going to involve a moderate amount of litigation, and the other is a kind of, you know, the meltdown scenario in which you have widespread class action lawsuits, you have courts disallowing throwing out previous foreclosures and all the things that would accompany that. I think the banks that are putting reserves aside here are just being prudent about because we really don't know which of those courses the events are going to take. As far as investors are concerned, I think that there really are two important things to understand. The first is that with respect to Fannie Mae and Freddie Mac mortgages, the way they operate is pretty straightforward. After 120 days of delinquency, Fannie Mae and Freddie Mac buy mortgages out of the collateral pools for their MBSs, and therefore the mortgage investors will not be faced with anything beyond that. If losses go up on Fannie and Freddie loans as a result of litigation, then those losses will be borne by Fannie and Freddie. And that's the biggest segment of the market. In the non-conforming market, the so-called, you know, the jumbo market, the subprime market, the triple option arm market, as it's known, and the alternative A markets, things are somewhat different. And
Don, I just want to jump in here and ask. You know, we unfortunately don't have time to get into the details, but from your perspective, does that effectively make maybe Fannie and Freddie, if not a better bet, a safer bet right now because of that, as you pointed out, that 180-day clause? If you're going to buy Fannie and Freddie bonds, you're going to be exposed to less uncertainty or less uncertainty risk than you would be if you were looking in jumbos or subprime or Alt-A or whatever.
Well, with respect to that particular issue, I think you're right. However, you know, what we're in right now is a situation in which, because of a kind of a pileup on the mortgage servicing highway due to foreclosures, all kinds of programs, most of which don't make a whole lot of sense, have been proposed, even with respect to Fannie Mae and Freddie Mac. So mortgage investors right now are faced with a market which has a lot of political and legal uncertainties involved in it. And frankly, what the market could use would be a lot less excitement, including excitement surrounding litigation and government intervention.
Donald, thank you very much. Don Brownstein of Structured Portfolio Management.